Assalamualaikum warahmatullahi wabarakatuh. For subject Bkaf 1023, we are going to present between two company, which is Binti Corporation Berhad and also Group Berhad. Hi, Assalamualaikum. My name is Mahfuzah Binti Ali, matrix number 290358. Before you go detail, let me briefly explain about the company that we have choose, which is we have choose Binti Corporation Berhad and also Berhad. So for Binti Corporation, this company specializes in mechanical and electrical engineering services, which includes electrical, mechanical, and power supply installation, instrumentation, and building automation, and also maintenance of electrical and mechanical system. Next, we move to Group Berhad, that stands for United Engineers Malaysia Berhad, or Group in Malaysian engineering-based infrastructure and services company with 4 key business, that namely expressway, township and property development, engineering and construction, and also lastly, asset and facility management.
Hello, good day everyone. My name is Nurul Ramlan, and now I will explain about liquidity ratio. First, I will give the definitions for the terms inside the liquidity ratios, which is current ratio and also quick ratio. Okay, current ratio is a liquidity ratio which can measure within 1 year of the company's ability to pay short-term obligations. It indicates how a company can expand the current assets on its balance sheet to appease its current debt and are payable to the potential investor and analyst. A current ratio that is aligned or a little higher than the industry average is considered healthy because it shows that the company uses assets efficiently. However, if the current ratio is lower than the industry average, it may tell higher risk or distress of the company. Okay, so for the quick ratio is a liquidity ratio that can measure the ability of a company to use its near cash or quick assets to stem out or pull out its current liabilities immediately. It is defined as the ratio between quickly available or liquid assets and current liabilities. Quick assets are current assets that can apparently be quickly converted to cash at close to their book values. The quick ratio is similar to the current ratio but provides a more stable assessment of the liquidity position of firms as it excludes inventory which is does not considered as sufficiently liquid. Okay, so now I will go to the calculation for the company, for the both company. Now we go through for the comparison for the both group. Current ratio. Okay, so Magenta has highest ratio, which is 1.412% compared to Binti Corporation Berhad, BKCB, which is 1.278%. That this indicates that Magenta group is slightly healthier compared to the other one because it managed to use their assets efficiently and able to pay short-term obligation within 1 year, which is actually the same because it has slightly different. But in terms of the for both comparison, Magenta has the most healthiest one compared to the other one. Okay, for the quick ratio, it is preferred to have a quick ratio which is greater than 1. This makes sure that the company has sufficient assets to pay off its quick liabilities. Magenta has highest ratio, which is 1.354% compared to Binti Corporation Berhad, which is BKCB, it is 1.278%. This shows that Magenta has slightly strong liquidity position as against Binti Corporation Berhad. Okay, like I said, it's just a slight difference, but with the slight difference, it can tell which one has the most stable and healthiest liquidity ratios. Okay.
As a conclusion, Magenta is the more higher point compared to Binti Corporation Berhad in terms of their current ratio and quick ratio financial performance. It is important for a company to maintain high liquidity ratio as it helps understand the availability of cash in a company, which determines the short-term financial position of the economy. Inventory turnover. A high inventory turnover generally means that goods are sold faster. Low turnover rate indicates weak sales and excess inventory, which may be challenging for a business. Inventory turnover rate is the key performance indicator. UEM overall performance have HG stable with far bigger record to compare with.
Hi, good evening to everyone. My name is PARIMALA GUANTARAJU. Currently, let me start with the total asset turnover. Total asset turnover, it is a financial percentage used to evaluate the efficiency of a company asset in generating sales revenue or sales income. So asset turnover is a part of activity ratio under the category of a financial ratio that determine how effectively a company uses the asset. So basically, company with a low profit margin will have a high asset turnover, whereby company with a high profit margin tend to hold a low asset turnover overall. So the calculation, it is a net sale divided by average total asset to get the ratio figure, whereby for the account receivable turnover, it is a method applied in business accounting to indicate how efficient one company managing their credit which they offer to the customer by measure the time circle involved on collecting the customer outstanding debt. So the formula is net sale divided by average trade receivable. We actually took two company to do the calculation, the ratio computation, which is a Binti Corporation and a UMA Agenta for year 2021. So the Binti beginning asset is a 340,713, ending asset 343,782. Average total is a 342,247.50. Revenue is a 58,262. Whereby for the UME Agenta is a 2 million. Beginning asset itself about 2,807,353. Ending asset is a 2,855,070. Average total asset 2,831,211.50, and revenue is 2,292,422. And total asset turnover ratio for the Binti is 0.17, and for UAM Agenta is a 0.81. So based on this, we can see that UME is actually slightly higher compared to the Binti Kindan. So however, both company still indicate which is below 1. So it shows that the company is still not efficient in using their asset to generate the revenue for the year 2021.
Assalamualaikum, my name is Hamizah binti Zahid. Number metric is 290367. In my presentation, I focus on profit margin on sale and return on asset based on company Binti Corporation Berhad and UEM Agenta Berhad. Now, I want to explain about profit margin on sale based on these two company. In short, profit is the money earned by a business when its total revenue exceeds its total expenses. Profit margin is profit stated as a percent of revenue. The method of calculating profit margin is simple: net income divide net sale. It indicates that over the year 2021, the company of Binti to generate profit margin on sale worth 0.18%, while the company of UEM Agenta profit margin on sale is 18.9%. It can be seen that company UEM has a large profit margin than company Binti because the profit Binti are decreased. Both company are able to generate profit, but company UEM has a better performance in managing its expenses. Profit margin is a method to detect this kind of situation. Next, I will explain about return on asset. The term return on asset (ROA) refers to a financial ratio that indicates how profitable a company is in relation to its total asset. Put simply, a higher ROA means more asset efficiency. ROA is calculated by dividing a company's net income by its total asset. As a formula, is expressed as net income divide average total asset. Companies Binti have low ROA 0.03% and more asset involved in generating their profit. Company UEM have a high ROA 15.3% and have fewer asset involved in generating their profit. As a result, company Binti have a low ROA tend to have more debt since they need to finance the cost of the asset. A rising ROA tends to indicate a company UEM increase its profit with each investment percent invested in the company total asset. A declining ROA could also indicate the company's profit are shrinking due to the decline sale or revenue. it's important to compare a company's ROA over multiplied accounting period. 1 year of a lower ROA may not be a concern if the company's management team investing in its future and is forecasted to increase profit over the coming year.
Assalamualaikum warahmatullahi wabarakatuh. To Dr. Zaimah, my name is Fatihah MOHAMED. My metric number is 290439. Today I will explain about my part is debt to asset ratio and debt to equity ratio. I will go through first for debt to asset ratio. Okay, next I will explain about debt to equity ratio. Okay, debt to equity ratio is calculated by dividing company shareholder equity by its total debts to reflect the company overall leverage and thus its ability to raise more debt by using the equity ratio. Investor can find out how to the firm performing in the capital structure and also how solvent the firm is overall. When an investor decides to invest in a company, he needs to know the company approach. If the company total liabilities are higher than their shareholder equity, investor will think whether to invest in the company or not, because having too much debt is too risky for the company in the long run. So the formula is debt to equity ratio formula is total debt divided by owner equity. From there, the investor can know whether they should invest to this company or not lah. Okay, next I will explain about the leverage ratio between two companies, which is Binti Kinder Corporation Berhad and UAM Agenda. Okay, for the leverage ratio, debt to asset ratio, measure the proportion of assets paid for by debts, giver loans and creditor used to debt ratio to estimate the amount to loan risk they will be by giving credit to organization. Okay, for the UM Agenda, show a low debt asset ratio value than the 2021 is 0.46%. They reflect that UEM has a conservative financing strategy that use only equity to pay for the asset. Okay, Milk Kindergarten Corporation Berhad show as a higher debt asset ratio value when the leverage ratio value of the 2021 is 0.6%. This shows that part of Binti Kinder Corporation Berhad financings come from debt. Okay, next about the leverage ratio for the debt to equity ratio. Okay, debt to equity ratio measure the risk of a company financial structure which compare the amount of long-term debt with the amount of equity. Debt equity ratio most often used to measure the extent to which a company takes on debt as a way to leverage its asset. UM Agenda shows the lowest debt equity ratio value than the debt equity ratio is from 2021 is 0.85%. Binti Kinder Corporations show a higher debt equity ratio value than the Binti Kinder Corporations is 1.58%. This reflects that UEM companies show a low amount of the debt financing through lenders compared to financing through equity to shareholder. To be concluded, from my observations, after interpretations, the leverage ratio of these two companies, I found that the financial position of Binti Kinder Corporation Berhad is not good because the debt asset ratio and the debt equity ratio that are higher than the industry average. Therefore, I believe that the financial situation of Binti Kinder Corporation can be improved if the company manage, improve their inventory management, pay off the loan without taking additional debt, try to increase the company profit and restructure the existing debt. However, UM Agenda company show a better average ratio. This is because the leverage ratio is very important for external user of the company as well as external user because this ratio will help to identify the weak parts of the company internally and help shareholders make judgment about their investment. Thank you from me, and that is my presentation part. Thank you.